commercial building and processing machinery and processing machines. Then number 3, we have commercial buildings. So you need to understand how to compute investment allowance in regard to investment in these 3 categories. So we'll start with the number 1, which we call it wear and tear allowance. So we'll start with number 1. I've already given you the notes. You can just listen, then you review the notes later on. So we have what we call wear and tear allowance. Wear and tear allowance. So under wear and tear allowance, machines are categorized into 2 categories according to their rates. So we have those ones that, so you need to know the categories. We have those ones that are 25%, and 10%. So these are the categories. So machinery and assets are categorized into 2 categories according to their rates. So we have those ones that qualifies under 25%. So you need to know those ones that qualifies under 25%. Under 25%, we have the first category under 25%. We have heavy earth-moving machinery, heavy earth-moving self-propelling machinery, self-propelling machinery, earth-moving self-propelling machinery, heavy earth-moving self-propelling machinery, e.g., we have forklift, we have buses, we have lorries, we have combine harvesters, we have bulldozers, we have truck engines, etc. So those heavy earth-moving machinery, those ones qualify as under 25%. At the same time, category number 2, we have other self-propelling machinery, other self-propelling machinery, e.g., motor vehicles. We have vans, pickups, tuk-tuk, motorbikes. So those ones also falls under 25% category. Roman 3 or 3 under 25% category, we have office electronics. Office electronics, e.g., we have printers, photocopiers, scanners, computers, ETR machines, computer softwares, etc. So those one falls under 25% category. So the first important thing, you need to know the machines and their rates under wear and tear. And then we have those ones that falls under 10% category. These other office machines and equipment, other office machines and equipment, e.g., curtains, office curtain, carpets, switchboards falls under this category, switchboards. And then we have fax machine. We have furniture and fittings, non-processing machines, we we have CCTV cameras. CCTV cameras. We have neon signs. Neon signs. We have bicycles. Bicycles. We have office equipments. Office equipments. Office equipments. We have billboards. Office partitions. Wheelbarrows. We have wheelbarrows. We also have so many others that falls under this category. So now the first thing you need to know what we mean by wear and tear. We're saying these are the machines that qualifies for wear and tear. So once you know now those, assets that qualifies for wear and tear, the next thing you need to know how to compute wear and tear. So how do you compute wear and tear? So this is, you write the rate, we have 25%, and then we have 10%. So you start with a residual balance, a residual value from the previous accounting, from the previous financial year, which we call it written down value. So you start with the written down value on 1st of January, maybe 2022. And then you write the figure here. You write the figure here. In case of any additional asset during the year, you add to their respective rates. Disposal of assets, you deduct from their respective rates. And then you get the net assets. You get the net assets. You get the net assets here. You get the net assets. And then now you compute wear and tear on the net assets. On the net assets. Then you get the written down value, 1st December 2022. So that is how we compute wear and tear allowance. That is how we compute wear and tear allowance. Therefore, now you need to understand what we mean by additional. What is it that we mean by addition of asset? So when it comes to the addition of asset, we mean, number one, the purchase cost of the asset. Additional, what we mean by additional is, number one is the purchase cost of the asset. Purchase cost, the amount of money that you spend to acquire the asset. And number two, any incidental cost. Incidental cost before usage of the asset. For instance, the transport cost from where you purchase to where you operate, insurance maybe on transit, any other repairs before you use the asset, or VAT, or any other tax that you pay before you start using the asset. Those ones are capitalized and they form part of the purchase cost. Number three, in case you acquire an asset through hire purchase. Hire purchase is where you pay deposit and the balance you pay installment wise until now you finish the entire amount that is required. So where you acquire an asset through that mean, the qualifying cost will be the cash price of that asset, the cash price. So the hire purchase has also, it is cash price. So the qualifying cost for wear and tear purposes will be the cash price. Number four, in case of trade-in is where you give out your old asset and you add some cash on top in order to get a new asset. So now for the purposes of qualifying costs for wear and tear, it is the market value of the old asset, the net book value, the market value of the old asset plus the additional cash given out in order to get the new asset. So the asset that you're giving out has its value in the market plus the cash that you're topping up so that you can get a new asset. That one will be the trade-in. And then also here we have what we call commercial and non-commercial vehicles. Commercial and non-commercial vehicles. We have commercial and non-commercial vehicles. So according to the definition of commercial vehicle, a commercial vehicle is a vehicle that is designed for carriage of goods and is used for that purpose, e.g. a van or a pickup, or a vehicle that is used for car hire services, e.g. taxis, or a vehicle that is used for public transport. That is a commercial vehicle. So if a vehicle is acquired which does not fall under the definition of a commercial vehicle, in other words, it is not used for public transport, it's not designed for carriage of goods, neither is it used for car hire services, then that vehicle is a non-commercial vehicle whose qualifying cost is restricted. Current restriction value is 3 million shillings, 3 million shillings. For example, if you buy a Mercedes-Benz to be used by the company's director, you buy the Mercedes-Benz, the value is 5 million shillings. That is the value of the purchase. That is the purchase cost. So because this is not a commercial vehicle, it's not used for car hire services, it's not used for public transport, nor is it designed for carriage of goods. So the qualifying amount will be 3 million. The excess 2 million will not qualify for wear and tear. So here we have what we call commercial and non-commercial vehicle. I repeat, a commercial vehicle is a vehicle that is designed for carriage of goods and is used for that purpose, or used for public transport, or is used for car hire services. If a vehicle that you buy is not a commercial vehicle, qualifying cost is restricted to 3 million. It should not go beyond 3 million. If it is beyond 3 million, 3 million will qualify. That is what we mean by additional. Then you also need to understand what we mean by disposal. What is it that we mean by disposal? For the purposes of wear and tear, disposal means the sales proceeds of the sales proceeds of the asset, the amount of money that you receive for the sale of the asset, the amount of money that you receive for the sale of asset, that is what is deducted here. It also means in case of insurance compensation where maybe an asset is stolen or is destroyed by enemies, either fire, and then there's insurance compensation for the asset, the qualifying cost will be the insurance compensation. Insurance compensation, that one will be the proceeds, insurance compensation. And then it also means in case of trade-in, remember you're giving out your old asset. So it will be the net book, the market value of the old asset, 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 and market value of the old asset. When you are also disposing of a vehicle that was acquired through restriction, in other words, it was an non-commercial vehicle and it's also being sold, you also restrict the proceeds by using this formula. We have the sales proceeds over the original cost times the restricted value at the date of acquisition, For example, this vehicle that we had given an example earlier on of a Mercedes-Benz, after usage for some time, you decide that this one should be sold off. Maybe you're selling it at 1.5 million, that is 1,500,000. Original cost was 5 million, that is 5,000. Then the restriction value at the date of acquisition was 3 million. So that is a disposal amount. You use this formula. If an asset that was acquired and it had been restricted when acquired, you also restrict when you're selling off using this formula, using that formula. So that is how we compute wear and tear. So the last thing you need to know under wear and tear, it is what we call balancing charge, stroke trading receipt, trading receipts. You need to know the definition of these two terms. So where you sell an asset at a value that is more than the written down value, the gain is called a trading receipt. If a business is a going concern, in other words, it's still in operation, or a balancing charge if it is coming to an end or is under liquidation. If you sell an asset at a value that is higher than the written down value, for example, the written down value of a computer is 10,000, and then you sell it at 20. This is the sale proceeds, 20,000. So you gain 10,000. The gain is 10,000. So we're saying the gain on sale of an asset above the written down value is called trading receipts if a business is going concern, or a balancing charge if the business is under liquidation. That is what we call trading receipts. And if you sell it at a loss, it's called a trading loss if a business is a going concern, or a balancing deduction if a business is under liquidation. So that is all you need to know on wear and tear allowance. We have the notes I've given them, I've forwarded. You can review those notes again. Then we're going to do questions on the same. So basically, this is the summary of all you need to know on wear and tear. We're saying you must know the qualifying cost, the asset that qualifies for wear and tear, and their rates. So you need to know this asset qualifies for these rates and this one, this one. I've given them out. And then you need to know how to compute. You need to understand what we mean by additional and disposal. We go to, unless you go to, that is all you need to know about wear and tear. We go to what we call investment. So we have investment land, industrial building. So we call them industrial building, and processing machinery, and industrial machinery or machinery or processing machinery. So we have investment land in respect to industrial building and processing machinery. So industrial building is a building that is used to convert raw materials into another product or a final product. So it's a house or a building that is used for conversion of raw material into finished products. And then there are machines that are also used, engaged for that particular purpose. So here you need to know the rate first. The rate is 50% in the first year of use, in the first year of use of the asset. So you take 50%, 50% of the fund, that is the amount of money that you're going to claim to reduce your gross profit. If you invest in an industrial building, the amount of money that you invest in that building, in the first year of use of the building, you're going to take 50% of that amount, and then you reduce it from your gross profit. In subsequent year, 25% in subsequent years on reducing balance basis. So that is the rate. That is number one, what you need to know on industrial building and machinery. Then number two, you need to know the qualifying cost, the asset that qualifies under this category. So number one, we have said, number one here is industrial building. So number one here, we have said industrial building. We have the industrial building, that one qualifies under this category. And then other civil works around the building, civil works around the buildings, e.g. drainage system, parking bay, parking bay. We also have the perimeter wall, the railway system, railway line, the railway line, the drainage system, electrical network. So the other civil works that you construct around the industrial building also qualify. We also have an extension to industrial building, extension to an industrial building also qualify, industrial building. We also have a substantial renovation, substantial renovation on the industrial building is also that also qualifies it. Number two, we have processing machinery, the machine that are used to process items, including the weighing machines. We have the weighing machines. We have the packaging machines. We also have conveyor belts. Those machines that are used to carry items from one part to another part of the building. We call them conveyor belts, packaging machine, weighing machines. Number three, we have those machines that are used to repair industrial machines. Machines used to repair industrial machines. Machines used. Number 4, we have those machines that are used to generate power, e.g. generators, produce power and distribute power, transformers, generators and transformers. And then number 5, machines that are used to distribute, store, and produce water, e.g. borehole, water tank, water pump. And then machines that are used for disposal of waste and environmental cleanup are also here, qualifies as here. We also have hospital machines. Number 7. Hospital machine. Number 7, we have ships and hotel buildings. Ships and hotel buildings, they will qualify here. So when you check your question paper, the top page of the question paper, they have given there a table with the summary of this machine and their respective rates. So if you see a machine having 50% at the rate, the first year of use, and 25%, then know that it qualifies under this category. It qualifies under this category on your top page of your question paper. So the 50, once you see the 50 and 25%, then definitely it qualifies as under this category. So you need to know those assets. And then another thing that you need to know under industrial building and machinery is what we call, when you construct an industrial building, it's a common practice to include some other buildings or the industrial buildings that are not used for the purposes of manufacturing. So it's a building that is annexed to the industrial building, but it's not used for manufacturing. For example, you can also include the administration block on the industrial building, or a showroom, or a retail shop. So those ones we call them non-qualifying cost. So you're going to compute their proportion in relation to the total cost. If their proportion in relation to the total cost is 10% and below, then they also be claimed under this category. For example, you use 10 million to construct an industrial building. In this 10 million, the showroom cost, is maybe 1,000. And then the admin block is also 1,000, 1 million. These two costs are included in the total cost of industrial building of 10 million. So we want to determine whether they should be claimed under this category or not. And how do you do that? You determine their proportion in relation to the total cost. So there's an unqualifying cost in the total cost is 2 million. 2 million, that is 2,000. I said showroom is 1,000, it's included in the 10 million. Then we have admin block, it's also included in the 10 million. So then unqualifying cost in that case, 2 million. So we want to determine whether they should be left to qualify under this category. So for them to be to qualify under that category, their proportion in relation to the total cost must be 10% and below. If they're above 10%, then they are excluded. And then now you multiply over the total cost, which is 10 million times 100%. So the answer you're going to get here, if it is greater than 10 million, the qualifying cost will be, if it is greater than 10%, the qualifying cost will be 8,000. The qualifying cost for under this category will be 10%. If this answer that you get here is greater than 10% by any figure, then the qualifying cost, they will be now eliminated from the total cost. I hope you're communicating. This is a very common testing area. So that will be 10. The cost of land does not qualify anywhere. Land is not regarded as a capital investment in terms of claiming investment allowance. And then the industrial building, for it to qualify, it must be new. Industrial building, you say, for it to qualify must be new. The processing machinery can be new or old, provided that none has been claimed before. None has been claimed before. So that is all you need to know on industrial building and machinery. That is all you need to know on industrial building and machinery. They are there in the notes, you can review them. And then now we have what we call commercial buildings. Commercial buildings. Commercial buildings. So this one, you need to know the rate the rate is 10% on reducing balance basis. Rate is 10% on reducing balance basis. So in other words, if you claim this year, maybe you buy, you construct a commercial building whose value is 10 million. So the first year, we're going to claim 10% of 10 million, which is 1,000. So the next year will be, the residue will be 9,000. So you're going to claim 10% on 9,000 in the next year. So 10% on reducing balance. Then you need to know the qualifying cost. I mean, those building, we term them as commercial. So number one here is what we call warehouse or storehouse, stock go downs. So those ones. Number two, we have office blocks or administration blocks, admin blocks. Number three, we have showrooms. Four, we have design rooms. Five, we have residential buildings or residential houses, residential buildings. Four, we have clinics. Five, we have sports pavilions. We have sport pavilions. And then six, we have swimming pools. Seven, we have which one? I may remember. So we have swimming pools, we have sports pavilion, clinics, residential building, design rooms, showrooms, office blocks. We have canteens. They qualify here. So those are some of the items that qualifies as here. And lastly, here on commercial building, they are prorated. So you claim them according to the time you began using them. Unlike the other investment allowance, which you talked about, that is wear and tear and industrial building and machinery. For commercial building, you prorate, you claim from the date you began using it. For example, if you construct a residential building whose value is 10 million in a year, whose value is 10 million, and then you start using that building somewhere around October in that very year. So you claim your 10% over 100 times the 10 million. 10 million is the amount of money that you spend to come up with a residential building. And then because you're using it from October, then you prorate it. That is 3 out of 12. So that is here you need to remember that you claim in accordance to the time you began using that particular building. So that is all you need to know on on commercial buildings. You need to know the rate, and then you need to know the assets, and then you need to know the proration. And lastly, there is what we call farmwork deduction. Farmwork deduction. So this is an allowance that is given for farming businesses for investing in capital items or non-current assets. So we call it FWD. So the rate is 50% in the first year of use of the asset, and then 25% on reducing balance subsequent years. So it is similar to industrial building and machinery. 50% in the first year of use of the asset, and 25% in subsequent years on reducing balance basis. So the qualifying costs here, are assets or immovable structures in the farm that assist farming business. Immovable structures on the farm that assist in the farming business, e.g., irrigation network, labor quarters, cattle dips, weather structures, e.g. wind vane, the storehouse or granary, the farmhouse, fencings, fencing system. So those structures that assist in the farming business, immovable structure that assist in the farming business. In case of a farmhouse, only a third of the qualifying cost qualifies under this category of farmwork deduction, because the farmhouse is partly used for private purposes and for farming purposes. So that is what qualifies for farmwork deduction. So that is all you need to know on farmwork deduction. Now, after that information, we have an opportunity to look at questions. We have an opportunity now to go for questions. In case you have any other question, you can post it so that now we can make things very clear and we move on. So we're going to review a question. We're going to review a question. As I had noted earlier, it's April 2022, question number 4B. So you open that question. April. So you're doing April 2022, question number 4B. So these questions are very important. They are examined, I think, in every sitting after the review of the syllabus. So you need to be very keen on them. So there, when you open your question paper, you'll find that table there. It has rates. Those rates that we've been talking about there, you can they can also be of help to you in case you forget. Now we go to the question direct. The question reads, Rolling Limited is a manufacturing company that commenced operation on 1st January 2021 after incurring the following expenditure. So there's purchase of land, factory building, parking bay, electric fencing, and then staff canteen, sport pavilion, go down. So other assets acquired at the commencement of operation were as follows. We have generator, water pump, water tank, sewage treatment plant, factory machinery, workshop machinery, photocopy and printer, saloon cars, furniture, lorry 3 tons, forklift, computers and scanners, fax machine. Additional information. Rolling Limited sang a borehole at a cost of 1,375,000, which was put in use on 1st September 2021. The factory building includes a showroom and an office block constructed at a cost of 660,000 and 440,000 respectively. The company constructed a factory extension at a cost of 2,400,000 and installed processing machinery costing 1.6 million on 1st June 2021. The company disposed of the following assets on 1st October 2021. So we have the lorry, we have fax machine and scanners. Number 5, the saloon car was involved in an accident on 1st July 2021. The company received 1.2 million in compensation for the loss in the same year. Required investment allowance due to Rolling Limited for the year ended at 1st December 2021. So number 1 here, we are going to start with those assets that qualifies for industrial building and machinery. So we've been told we have factory building. The cost was 9,350,000. So in this 1,350,000, we have been told it includes some other buildings that are not used for manufacturing. Why is it being told? In note number 2, the factory building includes a showroom. So we're going to determine the percentage of non-qualifying cost in the factory building, as we had discussed earlier on. So we're going to determine their proportion in order to know. Just a minute. So we can continue. So we are saying we want to determine the proportion of non-qualifying costs in the industrial building. So those costs are indicated in note number 2. The factory building includes the showroom and office block at a cost of 660. So we're going to add 660 plus 440. I've deleted the zeros over the total cost, which is 9350. The total cost, I hope you can be able to see those figures. Then you multiply by 100. So the factory building, it includes a showroom and an office block constructed at a cost of 660 and 440,000. So the total cost is 93. So these two other costs are inclusive and included here. So 660 plus 440, you divide 9350, and then you multiply by 100. So that is 11.7%, which is greater than 10%. Therefore, the qualifying cost is going to be 9350. You deduct these two costs. You deduct, so you're going to take 9350, and then you deduct 660 and 44. So this one is going to give you 8250. So that is be the qualifying cost for factory building. Then here we write the name of the company. We write the name of company. It's called Rolling Limited. So Rolling Limited, computation of investment allowance, computation of investment allowance for the period ended, 31st December 2021, 31st Dec 2021. Then you underline. So you start here factory building and machinery. So you start here factory buildings and machinery. That is the first category. Factory building and machinery. So you're going to write here the asset, and then the qualifying cost, shillings and thousands. Here we say the rate in the first year of use at 50%. Then will be the residue carried forward. We have the residue, balance carried forward. So we'll have those ones. So the first year we have the fact, we say the cost of land does not qualify anywhere. So Rolling Limited is a manufacturing company that commenced operation 1st January 2021 after incurring the following cost. So those all costs will qualify. So here we have the factory building. So you write here factory building. According to our computation, the one that qualifies is 8250. So 8250, we take 50% of that one. 8250, then we divide by, so this one will be 4125. So the 4125 will remain. Then the next, we identify the other items. So we have parking bay. Parking bay will also qualify here. Parking bay will also qualify under this category. The total amount is 660. 660. We have electric fence to also qualify under this category. Electric fence. Electric fence is 132,000, so that is 132. Remember, we're putting there thousands. And then we have staff canteen, sport pavilion go down. Then other assets that were acquired at the command of operation was follows. We have generator. They also acquired generator. Generator, the amount was 740. Water pump, I'm just listing them before I claim. Water pump, the amount is 190. And then we have water tank. Water tank, the amount is 100,000. And then we have sewerage treatment plant. Sewerage treatment plant. Sewage treatment plant, the amount is 330. We have workshop machinery. Workshop machinery is 1760. We have photocopier, furnitures, computers, fax machine. Additional information, number one, Rolling Limited sang a borehole. We have borehole. We have a borehole, the cost is 1375. 1375. Then there is note number 3. The company constructed a factory extension. Factory extension. We said it qualifies as here. Factory extension, 2,400,000, 2,400. Install their processing machinery. Then we have processing machinery. Processing machinery. The cost is 1,600,000. So those are the item that qualifies under that category. So we say we claim 50%, 660 times 0.5. So this one will be 330. You claim 330, 132 times 0.5. This is 66, 740. This is 370, 190. This is 95. And then this is 50, 30. We divide by 2, this is 165, and then 1760 divided by 2, this is 880. Then we have 1375, you divide by 2, this is 687.5, 687.5, and then we have 2,400. This is 1,200, and then we have, this is 800. So the remaining, the residue will be 330 here. This is 366, 370, 95, 50, 165, 880, 880, 687.5, 1,200, and 800. So this is the total amount that you're going to claim that year in regard to factory building and grant. So you add them for 125 plus 330 plus 66 plus 370 plus 95 plus 50 plus 165 plus 880 plus 687.5 plus 1,200 plus 800. So the total claim is going to be 8768.5. That is what you're going to claim that year for industrial building. Then here, you're going to claim the second category, the commercial buildings. Commercial buildings. Commercial buildings. So you're going to write here asset. And then here we have the qualifying cost. Here we have the rate at 10%. And then here we have the residue, balance carried forward. So these are shillings and thousand. Make sure that you indicate shillings and thousand. So we're going to identify those assets that qualifies as under commercial building from the information that we have. So when you at the onset of the statements, we have a staff canteen. Staff canteen. We have a staff canteen. The cost is 1320. That is the cost. And then we have sports pavilion. Sports pavilion. The cost is 700. And then we have go down. The cost is the cost is 990. 990. We have others. So this one we're going to claim at 10%. They have been used from January to December. So we are not going to prorate. Remember, under this category, you claim in accordance with the time you began using the asset. So this one will be 132. It was used from January to December. Here we're going to use 10%. So this one is going to be 132. So this one is going to be 132. This one is going to be 70. And this one is going to be 99. So that is what we're calling, that is what is going to be claimed for those assets. And then other assets that were acquired during the year. So the factory building, we also had a showroom. Remember, we also had a showroom. It did not qualify under factory building and machinery. If it had qualified, I mean, this percentage was 10% and below, we had claimed them under this category 1, then you would not have claimed them again here. So here we had a showroom, note number 2. Showroom here 660 from January. That is now you're going to claim the entire amount, which is 66. And then we had office block. Office block, which is office block was 440. So this one is going to be 44. So according to the details we have, those are the only items that qualifies as under commercial buildings. So we take 1320 minus 132. So the residue here will be 1188. Then we have 700 minus 70. This one will be 630. Then we have 990 minus 99. This one will be 891. Then we have 660 minus 66. 594. 440 minus 44. This one will be 396. So what we are going to claim 132 plus 70 plus 99 plus 66 plus 44. So we're going to claim 411 under industrial buildings, under commercial building. Lastly, here we have wear and tear allowance. So we write here the rate, we have 25%, and then we have 10%. So we said we set the written down value 1st January 2021. This one was not there because it was when they started the business, so they had not yet claimed before any. So there's no way they would be having the written down value. Then you add the additionals, additional during the period. So we go there, we have so we have photocopier and printer. So here we have photocopier and printer. Photocopier and printer. The total value for photocopier and printer is 150. So you write here 150, it will be dash. So we also have saloon car. Saloon car. The total value is 3,200,000. Remember, we said a saloon car So now we have saloon car. Remember we said a saloon car is an non-commercial vehicle. We define what is a commercial vehicle. So the amount that was spent to buy this saloon car was 3,200,000, which is way above the restricted value. So we're only going to claim 3 million. And then we have furniture. They also bought a furniture. The value of furniture was 165. So here you can write 3 million and R restricted. Then they had lorry. They had a lorry which is 1380. And then forklift. Forklift is 880. And then we have computers and scanners. Computers and scanners. Computers and scanners, which is 330. Then we have fax machine, which is 120. 120. So 120. So those are the assets that were acquired under wear and tear. Then we had disposals here, the assets that were disposed of. disposals. Note number 4. So we have disposals. Note number 4. The company disposed of the following assets on 1st October 2021. Lorry, so the fax machine, you see, so we come here and write here lorry, the lorry 900. So you deduct 900 here. And then the fax machine. Fax machine is 50. So it is under this category, you deduct. And then we have scanners. Scanners is 80. So you deduct this 80. And then the saloon car was involved in an accident on 1st July 2021. The company received 1.2 million as the compensation for the loss in the same year. So now here we compare the disposal saloon car. Disposal saloon car. Remember we said, if you dispose of an asset that was restricted when acquired, then you also restrict the disposal value by using the formula sales proceeds, the amount of money that you receive for the sale over the original cost times the restricted value at the date of purchase. Restricted value at the date of purchase. So in the case of insurance compensation, we said it is the insurance compensation that is considered as the proceeds. So the amount of money that was received as proceeds now in this case was 1,200,000. The original cost, remember, was 3,600,000 of saloon car. 3,200,000, sorry. The original cost was 3,200,000 and the restriction value was 300,000, 3,000, not 300,000. So that's 3 million. Here, these values are in thousands. So 1,200, you divide by 3,200, and then you multiply by 3,000. So the value you get here is 1125. So we come here and deduct saloon car. Saloon car, which is 1125 under this category. And then you get the net assets here. You get the net assets. So you add 150 plus 3,000 plus 1,380 plus 880 plus 330 minus 900 minus 80 minus 1125. So you get 3635. 3635. Then we have 165 plus 120 minus 50. So you get 235 here. Then now you claim here wear and tear allowance. 3635, you claim at 25%. So you get 908, 909. So you deduct, I've rounded it off. And then 235 times 10%. So this one will be 23.5. So the written down value, 31st December 2021, under the 25% will be 3635 minus 909, which is going to be 2726. Then 235 minus 23.5 is going to 2011.5. So this is the value that you begin with in the next year. So any additional during the subsequent year, that is 2022 in our case, will be added to these two values. This one will be the written down value at 1st January 2022, the written down value at the end of a particular year. So this is how we approach questions on investment allowance. So if you scrutinize your question papers, you realize that every sitting we have this question. Every sitting we have this question. So you can check December 2021 as your assignment. You can attempt question number. You can attempt question number 5C. You can attempt question number 5C. You can attempt question number 5C. And the other years. And the other years. So that is how we do those questions. For today, we're going to stop at that point, and then maybe tomorrow. So I have given you assignment. Let me write here assignment so that you don't forget. Assignment, we've said which one is this? So this is you attempt this one, and you can scan it and send it to my WhatsApp, and then I'll be able to check. December 2021, question number 5C. Question 5C. December 2021, question number 5C. Is it December really? Let me confirm. December 2021, question number 5C. And then we also have September 2021, question number. So you attempt this one only, then I'll give you more assignments tomorrow. So tomorrow you let me know if you can also avail yourself at the same time. You can also go through another topic. So these are all topics that you've done today. You need to reinforce it with questions, and then you need to let me know how you're progressing. For now, unless you have a question, our class is going to come to an end at that point. Any question? So thank you very much. Until tomorrow.